Hi, Andrew. How are you doing?
Hello, David. All right. Hi.
Good. So talking today about venture capital trusts.
Yeah.
I guess in some ways, everything you ever want to know about venture capital trust, but we're afraid to ask. So to the uninitiated,
Yeah.
can you give a brief description as to what a venture capital trust is?
Absolutely. Yeah, absolutely. Venture capital trusts were brought in 1995, actually. So legislation was enacted quite some time ago, now 25 years ago. And it was really brought in to encourage investment into small companies. Okay, that's ultimately what it was brought in to do, and really all it is, if you sort of think about this as a sort of a picture, a VCT is just a company. That's all it is, nothing more complicated than that. So if you think of a venture capital trust as a big box, this is the way I sort of draw a picture if I was showing this on a whiteboard, or is to say it's a big box, and people buy shares as they do in companies, and they buy shares in that company, in the venture capital trust. And with people's money, the venture capital trust then deploys that money across acquiring sort of stakes, if you like, shares in a portfolio of small companies. Essentially, that's really all a VCT is, before we sort of get into a bit more of the nitty gritty. But that's really what it is. So you're really investing in a portfolio of smaller companies, but not directly in them. You're investing via this wrapper called a venture capital trust.
Okay, so that's it.
That's structurally that's all it is, David. Absolutely.
So in simple terms, that's the what. I suppose the next question would be the why in some ways. So tell us a little bit, if you would, about the tax breaks, the advantages for clients.
Absolutely. Well, the tax breaks have changed slightly over the years since they were first introduced. But as we sort of sit here today, the main tax break for venture capital trusts is that if you put £100 into a VCT, then HMRC will pay you back up to 30% of the amount that you subscribe for shares. So if you put £100 in, if you've suffered at least £30 of income tax in the tax year in which you buy the shares in the VCT, then HMRC will repay you that £30. Okay. So in other words, if looking at the numbers really simple, if you put £100 in, they give you £30. So the net cost to you is effectively £70.
Yep.
It works just for the current year income tax planning. So you have to invest the money in the current tax year. So right now we're in obviously 2021.
Yep.
So you have to buy your VCT shares in order to get that tax relief before the 5th of April this year. So as you can imagine, now people tend to do their income tax planning later in the year because that's what people do. So it's very much sort of VCT season now, if you like.
So unlike pensions, for instance, no carry back, no carry forward. It's just the current year.
Absolutely, it's just current year, exactly. Very popular at this time of year. So the first tax break, as I said, is purely that income tax. Now, obviously, you're rather, albeit it's costing you £70 net. Of course, £100 is going into the VCT, and £100 is being deployed across this portfolio of companies. Yep. So, the companies that you can invest in can't be above a certain size because obviously the government want to encourage you to invest in smaller companies. Yeah. So trying to keep this simple again, the maximum size of company is the gross assets at the time you invest in a company, or the VCT invests, and can be no more than £15 million. There can be no more than 250 employees in that company, and we have to invest in the first 7 years of the trading life of that company. So that's sort of the criteria around it, really. Now, once you're invested in the VCT, David, you have to hold those shares for 5 years in order to keep the initial income tax relief that you claimed at the start. You can come out earlier, but if you come out earlier, you forfeit that initial tax relief. So people sort of come into these things understanding that really it is a 5-year play. Now, over that 5-year period, obviously, the value of the VCT, we hope, will increase because the size of the companies that are in the VCT will grow. And so the value, if you like, the VCT value of the companies in it will grow, and hence your investment grows. But over that period as well, as the underlying companies grow, they may well be able to pay a dividend as they grow and have the cash available to do it. That cash from those companies is obviously paid into the VCT.
Yeah.
not to you as a shareholder. If you don't own the shares, it goes to the VCT, and the VCT can pay that cash out to your client, if you like, as a shareholder. And those dividends out of a VCT are tax-free. So as well as the initial tax relief, over the 5-year period, people quite like VCTs because they may well give them a fairly regular dividend stream potentially, which are all tax-free. Also, of course, over that 5-year period, it's very likely that a number of the companies that are in the VCT will be sold. So the VCT share the company will be sold somewhere else or floated or something. And the VCT realises a lot of cash potentially in the VCT. And again, that can be paid out as a tax-free dividend to clients. So really, hopefully that covers off the initial tax break, tax-free dividends, and the growth.
Okay. So you described the what, you described the why, and it all sounds really positive.
Yeah.
We'll look at the kind of the balanced position, if you like. Tell us about the risks.
Let's look at the why not. Absolutely. Listen, my world of sort of tax efficient investments, I think it's important to set this out, and it very much includes VCTs. From the FCA's perspective, they deem the VCTs as high risk. Now, what we define as high risk is another conversation, another debate. But essentially, you are coming into a portfolio of small, typically unquoted companies. So by default, really, David, you're not buying shares in BP or a huge diverse fund of large global companies. You are buying a portfolio of typically unlisted, smaller UK companies, and hence that's very much deemed high risk. There are VCTs out there where you can invest in AIM listed companies, so companies listed on the alternative investment market. But again, the same criteria apply in terms of the size. So they, just because they're AIM listed companies doesn't mean they can be big AIM listed companies. They still have to satisfy that test. So I think with certainly when we advisors sort of write suitability letters on here, they very much say, listen, unquoted younger companies can fail, of course. So there is the real risk to capital here, and all over letters will say, listen, you could lose your money here. When you are invested in hopefully a diverse portfolio of companies within one venture capital trust, typically what will happen is there will be some failures. There will be, one or two companies that don't perform very well. Some will flatline and not really do a lot. Some will fail completely, but perhaps and hopefully one or two will do very, very well. And normally in those instances when one or two very, very well, then over the whole the VCT as a whole, clients will see a net positive return, as well as the tax relief. Okay, and that return obviously is that combination of dividends over the 5-year period and underlying growth in the value of the underlying companies.
Okay, so as you said, to almost summarise what you said there, some really positive things in terms of the tax breaks, in terms of the diversification, but there is an exclamation mark at the same time saying, there's a bit of caveat emptor there, and this really is to be used as in a diversified way and in a managed way, but as part of the bigger picture of a client's overall investment piece.
Absolutely. I think what's helpful with VCT, certainly perhaps as opposed to one or two other tax efficient investments that you'll see on the market, is the minimum amount that you need to invest in VCTs is typically about £5,000. So it's actually quite low. So people can in a way dip their toe, shall we say, in VCTs. They don't have to commit a lot of capital. And certainly for you as advisors, when you're looking at a portfolio as a whole, it doesn't have to skew a portfolio that much, so that it can still maintain that sort of moderate risk or cautious approach that the client really wants to take.
Okay, that's excellent. Well, what would really help is just sort of think about wrapping it up. Be good if you could maybe talk us through a couple of examples, perhaps.
Absolutely.
Typical client, if there is such a thing.
For sure. I think the biggest reason why the demand for VCTs has always been relatively strong. It's grown over the years, but certainly in the last 3 or 4 years, it's grown immeasurably. And that really is a result of the restrictions that the government has put on tax relief on pension contributions. So as you know, we get to our marginal rate of income tax. We will get tax relief on our pension contribution at that rate. But obviously, when you start to earn over a certain amount, then the amount of pension contribution you can make and still get tax relief starts to come down. So there's an annual allowance, if you like, which caps the amount that we can put into a pension. There is also, as we know now, a lifetime allowance as to what we can put into a pension and still get tax relief. So as you can imagine, there are lots of people out there who earn quite a lot of money still and obviously suffer significant amounts of income tax, but are limited as to how much they can still do into their pension, we're being an annual allowance or a lifetime allowance. So that's where we see the demand for VCT. So a typical client might be, I don't know, 45, 50, 55, 60, something like that, who's earning still quite a lot of money, but might have put a lot of money into pensions, and now is looking for something else where they can reduce their income tax liability. And that's where that 30% income tax credit comes in. The tax relief on VCTs applies to absolutely any income. So that could be bonus, salary, self-employed income. But yeah, I think absolutely. A typical client is that person maxed out on the pension. The other one that I often see personally are owner managers who build up money in their company and then decide that at some stage they'd like to take it out and enjoy it. And of course, there's income tax on those dividends. Now, with a dividend, you can't make a pension contribution to reduce the income tax on a dividend. But as I said earlier on, VCTs applies to any income tax. So again, you could, if you took, let's just say you took £100 out of a company, and the dividend tax on that was 32.5%. If you're a high rate taxpayer, then we could put that 100 into a VCT, obviously get 30 back. So of that 32.5 that we're about to give to HMRC, we can have 30 of that back. So effectively what we do is get that money out of the company at 2.5% income tax. Yes, we have to hold it for 5 years and all the rest of it, but as long as the client's comfortable, then that works. So yeah, dividends and pension planning, I think, are the main ones.
Okay, no, that's really useful. I say, I think at a high level, that's given a really good flavour and taster for what VCTs are all about.
Yeah, pleasure, absolutely.
Thanks very much for your time.
Thanks. Cheers, Dave. Thanks. Cheers. Thank you.